Hello everyone. So today we are going to continue our chapter 6, and you know the title of this chapter is Intercompany Sales. Intercompany sales, and we are focusing on the plant asset. So this is part B. The part B, we are going to talk about intercompany sales of depreciable property. And in part A, we discussed about intercompany sales of non-depreciable property. So if you find the property is is about land, okay, if you find that intercompany sales is about land, then it is non-depreciable. But equipment or building or any other asset other than land are depreciable property. So read the question carefully, that whether we have depreciable or non-depreciable property, because they have different treatment in accounting if we have depreciable and non-depreciable. So this is one point you have to remember. Then let me explain the main points again. So you have to find out whether parents company sell asset to subsidiary or subsidiary sell asset to parents. So parents, for example, parent company sell plant assets to subsidiary company. Or we have opposite, and you know that whenever we have sale of plant asset, we, as it is intercompany, we may have intercompany gain or loss. Intercompany gain or loss. And if it is intercompany gain or loss, it is called unrealized gain or loss. So this is parents company sell plant asset to subsidiary. So we may have opposite. We may opposite like a subsidiary company sell plant asset to parent company. And in both cases, we have intercompany gain or loss, and it is called unrealized gain or loss. So what should we do in this case? We have to eliminate intercompany gain or loss. Intercompany gain or loss we have to eliminate. And this is the first point we are going to do. Okay, so the first main point here is we have to eliminate intercompany gain or loss. After eliminating intercompany gain or loss, then we have to return back the plant asset in its original shape. Original shape means original cost. So you have to record plant asset to make it return back the original shape. I mean the original cost. And this is the part two. Part two. So these two important parts for the intercompany sales of plant asset. Okay, so you have to remember up to here. Then another important point that if parent or subsidiary sell plant asset to the third party. Okay, if parent or subsidiary sell plant asset to subsidiary as to third party, in this situation, we have realized gain or loss. We have realized gain or loss. So this realized gain or loss, we cannot eliminate them, but report them in the consolidated financial statements. So if you have any realized gain or loss or earned gain or loss that came from third party, we cannot eliminate them, but we have to report them in the consolidated financial statement. So you should remember that subsidiary company prepare financial statements separately, parents company prepare financial statements separately, but in addition, parents company prepare the consolidated financial statements. Okay, both companies have separate financial statements, but parent company additionally do more statements that are called the consolidated financial statements. Then when you read the question, you have to think about whether it is upstream okay, or whether it is downstream. Because if it is upstream, okay, if it is upstream, then we have to establish NCI. If it is upstream, that means gain or loss transfer subsidiary to parent, right? That means parent cannot accept 100%. Okay, parent cannot accept 100% because sometimes parent own 80% or 90%. So if it is upstream sales, we have to establish NCI. If it is downstream, we do not have any NCI. Okay. Then you have to read the question. The question will clearly tell you the method. Cost or partial if your question is about cost or partial method, okay, then we have to eliminate, okay, we have to eliminate intercompany gain or loss from beginning written earnings. So if it is cost method or partial equity method, we have to eliminate intercompany gain or loss from beginning written earnings. So if it is completely equity method, we have to eliminate intercompany gain or loss from we have to adjust or eliminate, okay, intercompany gain or loss from subsidiary account, investment in subsidiary, because everything we adjust, if it is completely equity method, we adjust every gain or loss with one account, and it is called investment in subsidiary account. So these are the sorry. So these are the main points about this chapter. Okay. But whenever we have depreciable property, okay, whenever we have depreciable property, the problem is more challenging. The problem is more challenging because of the depreciable property. And this is really very important topics for the consolidated financial statements, depreciable property. Now read one question and solve it. Problem 1 is about cost method or partial equity method. So they are similar. Whether cost method or partial method, according to intercompany sales of plant asset, we have similar way to do. So parent company, Powell company owns 80% of the outstanding common stock of subsidiary company. So as it is upstream sales. Why it is upstream? Because on June 30, 2021, subsidiary company sold equipment to parent company for $500,000. So based on this information, we can understand that this is upstream sales. So whenever we have upstream sales, you have to remember that you have to establish NCI for remaining 20%. So we should have NCI account, okay, because it is upstream sales. And this date is important. On June 30, 2021, subsidiary company sold equipment to parents company for $500,000. So this $500,000 is the selling price of subsidiary, right? This is the selling price of subsidiary, but this is the purchase price of parent. You understand? That means it is the cost of parent, but sales price of subsidiary. So this number is important to calculate gain or loss. And this number is important, this date is important, June 30, 2025, because usually we record depreciation based on 1 year, right? You learn from your principles of accounting 1 or advanced accounting that we calculate depreciation for 1 year. But here, as we have partial date, right? That means we sell inventory, that means subsidiary sell inventory to parents on June 30, 2021. So we have to record depreciation for 6 months. You understand? So this date is important. So if I change this date in the exam question, I change it like on January 1st, 2021, then we have to consider 1 year depreciation expense, right? But here, as the date is June 30, that is 6 months remaining. So we have to calculate depreciation expense for 6 months. So this date is important. So we know this is the sales price of subsidiary and the cost price of parent. Then you know that whatever the sales price is, doesn't matter. We have to return back the plant asset in its original shape, right? So you have to find out what is the original cost of this equipment. The question said that the equipment cost okay, subsidiary company, $780,000. So this is the original cost of the equipment of subsidiary. So when subsidiary buy this equipment, it was $780,000. When subsidiary sell this equipment to the parents, they charge $500,000. And at the day of the sales, the total accumulated depreciation is $400,000. Right? So this important number is given, and the management of Powell company estimated that the equipment had a remaining useful life for 4 years from June 30 of 2021. So June 30, they sell the asset and parents company buy the asset. Okay, and parents company estimate that they can use this asset for the rest 4 years. And it is started from June 30, 2021. So from June 30, 2021, they are going to start to use this equipment, okay? And they estimate that they can use it for coming 4 years. In 2022, Powell company recorded $300,000 and this company recorded $200,000 net income from their independent operations. So they do independent operation and they have separate net income, including sales, but excluding the dividend. Anyway, so in this chapter, I am not going to ask you to prepare the work paper. Okay, I am going to ask you to do only the journal entry. So this information are irrelevant. This information is irrelevant because I will ask you only journal entry. Now, first requirement. What happened? What happened June 30, 2022? Okay. So we know that June 30, 2022, parent company buy this asset and subsidiary sell this asset. So what is the journal entry for this? We are going to write the journal entry. So parent company bought equipment from subsidiary, right? And subsidiary sell equipment to parent, okay? And recognize gain or loss. Gain loss. And recognize gain or loss. So this is happened in the first date. Now look at the journal entry. Parent company buy equipment. So they receive equipment, their equipment increase, it is debit. Do you understand? So this journal they record $500,000 equipment debit, and they pay cash. This is mistake. You can correct this. And they pay cash $500,000, right? So what is the important point here? Look at here. We have to return back our asset. We have to return back our asset to its original shape. The original shape is $780,000. So equipment debit $500,000, right? So if you want to return back its original shape, later on you have to add another $280,000, right? Do you understand? So I will show you later on, but this is for your information that today we record equipment $500,000, but main point said that the formula, that means the rules of intercompany depreciable asset said that we have to return back the plant asset in its original shape. Okay, so original cost is 780. Today they record $500,000. Later on they have to add another $280,000. Anyway, so this is the first journal. What happened June 30? Parents company buy asset, they record asset debit, they paid cash credit. What the subsidiary company is doing? So now you have to apply your intermediate accounting knowledge that whenever you sell a depreciable asset, okay, that means you are going to sell the book value, right? You are going to sell the book value. So this is the calculation of book value. How to calculate the book value? If it is depreciable asset, cost minus accumulated depreciation. So it is subsidiary account. So the original cost was $780,000 minus accumulated depreciation $400,000. So the book value is $380,000. Okay, so whenever you are going to sell your asset, it means that you are going to sell the cost price and you are going to close the accumulated depreciation. So book value is $380,000, but from market, okay, or from parents, subsidiary company receive $500,000. So they receive more money. They receive more money than the carrying value of the asset. Okay, so they have gain. They have gain. So first they record gain. Look at here. First the record gain. First the record gain. It is $120,000, and they receive cash. They receive cash $500,000. So they receive cash $500,000. They record gain $120,000, and they sell their equipment $780,000 credit and accumulated depreciation debit. So these two journals, accumulated depreciation debit, okay, accumulated depreciation debit and equipment credit. It means that they sell the equipment. So these two items together, sale of equipment. Can you remember your intermediate accounting knowledge? So you sell equipment credit. Okay, this is the cost minus accumulated depreciation, right? Cost minus accumulated depreciation. So you record cost credit, accumulated depreciation debit. So the middle two journals means that, okay, we close our equipment. So subsidiary do not have this equipment, right? So they close it. Anyway. Do you have any question about this journal? Now, just for your information, we recorded $500,000. Then later on, we have to add something, okay? We have to add something to make it original shape, okay? This is one part. Another part is, this is called intercompany gain or loss, right? This is called intercompany gain or loss. So, need to eliminate. So we need to eliminate, okay, we need to eliminate this journal, I mean this account, and so this is two important point here. We need to return back the original shape. Okay, we need to return back the original shape, and we need to eliminate these two, right? We'll do it very soon. We'll do it very soon. So this is the journal, what happened when we sell it. So this is June 30. Try to understand, this is June 30. Now, when company prepared the consolidated financial statement, company prepared consolidated financial statement December 31st, right? Now December 31st came. Now December 31st came. What should we do at that day? So prepare work paper entries. Prepare work paper entries necessary because of the sale of equipment, okay, for the year ended December 31st, 2021. So just 6 months later, what should we do? So look at this schedule first. This is something like workings that will help you to find out some important number that we need to adjust later on. So the original cost of this equipment by subsidiary company was $700,000 and $780,000. So this is the cost column. Look at it, cost and accumulated depreciation. We can do it together. Cost of subsidiary was $780,000, and they recorded accumulated depreciation $400,000. Okay, and we know that cost minus accumulated depreciation equal book value, right? So December 31st, 2021, the book value is $380,000. So we already calculated here. We already calculated this amount already here. So cost minus accumulated depreciation equal book value, right? And how many years remaining? We have 4 years remaining, this plant asset. So we can record depreciation expense, and this question assume that we assume that we follow a straight line method, a straight line depreciation method. So cost, this is a subsidiary company, because subsidiary company will record it separately, we know that. So cost minus accumulated depreciation equal book value. We have 4 years remaining divided by 4, right? And this is the $95,000 depreciation for each year. Now this company goes to where? This company goes to the parent company, right? And parent company buy it by paying $500,000. And when they buy it in the year 2021. Okay, so they don't have any accumulated depreciation yet, right? Why they don't have any accumulated depreciation? Because they haven't recorded. So they are going to record very soon. So they don't have any accumulated depreciation. So the carrying value is $500,000 divided by 4, and we find that the depreciation expense is $125,000. Now, what is the difference of these two? So the cost difference is $280,000. Original cost is $780,000. Parents company record 500. So there is a difference $280,000. Therefore, when we prepare consolidated financial statement, we have to return back asset in our original shape. Okay, so therefore we have to add this $280,000. Okay, to make it original shape. And if you record asset, you have to record the accumulated depreciation also to make it the original shape, because according to the original shape, this is the cost, right? And this is the accumulated depreciation. So as it is depreciable property, try to understand. As it is a depreciable property, whenever you are going to make it in original shape, it should be both cost price and both accumulated depreciation. Clear? But if it is non-depreciable, you no need to think about accumulated depreciation. But as it is depreciable asset, whenever we convert it to its original shape, it means that we should convert it to the original cost and the original accumulated depreciation. Now look at this journal. If you record, it came from here. First, we record only $500,000, right? And it is debit. But if you want to make it 780, that means you have to add another 250 here. Clear? Therefore, we record, look at it, we record this one debit. This one debit. So equipment debit $280,000. Before we record equipment debit $500,000. And if you do the T account now, according to the T account, what is the balance? Balance is 780, right? Okay, so we already done this part. And I told you that whenever we make it original shape, we will have to make it original shape based on the cost price and the accumulated depreciation. So before we already closed the accumulated depreciation, right? We already closed the accumulated depreciation, but we have to return back to the original shape. When we return back the original shape, now the accumulated depreciation should become credit. Clear? Look at here. So equipment debit and accumulated depreciation credit. What does it mean? It means that we reshape our asset in its original form. We done this, right? We done this part. We done this. Now we know that we have intercompany gain or loss. So as we have intercompany gain or loss, we record it credit, but it is unrealized. To close, make it debit, right? To close, make it debit. Now we record gain on sale of equipment debit. Yes. So this journal is about two main points. I told you that we have 2 points. This is the first point. Can you remember the first point? First point is eliminate intercompany gain or loss, right? And second point said that reshape the asset in its original form. Reshape assets in its original form. So look at the main points here. These 2 main points. These 2 main points. We have to eliminate intercompany gain or loss, right? And we have to return back the plant asset in its original shape, as it is a depreciable asset. So we have to adjust with cost and accumulated depreciation. So this is done. Now we find that we have, so we adjust the differences. We adjust these differences. Look at here. We adjust this difference. We adjust this difference, right? And we already close intercompany gain or loss. So up to here, we done everything. Do you understand? According to this table, we adjust our cost. We adjust our accumulated depreciation. We record unrealized gain or loss, and we already close it, right? Now, this is important number because of the depreciable asset. So if you remember your accounting knowledge, that whenever we prepare our financial statement, we record depreciation expense, right? And when we record depreciation expense, we have to calculate depreciation expense based on the original cost. Do you understand? Depreciation expense always recorded based on the original cost. Now, according to the original cost, look at here, this is the original cost. According to the original cost, what is our depreciation expense? Our depreciation expense is $95,000. Because this is the accounting rule, right? This is the US GAAP or IFRS. Whenever you are going to record depreciation, it should be based on cost price. So according to cost price, the consolidated financial statement should record depreciation expense $95,000. But as we have intercompany sales, right? Intercompany sales, now parent's company going to record depreciation because this is the cost of the parent company. This is the cost of the parent company, and parent company record depreciation based on their cost, right? Based on their cost. So parent's company record depreciation $125,000. But we know that when we prepare the consolidated financial statement, it should be based on the original cost, right? So look, parent's company record $125,000, but subsidiary record $95,000. Therefore, we have $30,000 additional depreciation expense for this year. Which year? 2021. 2021, we record depreciation twice, right? One by parent company, another by subsidiary company. And we find that the difference is $30,000 more. But actually it should be $95,000. So $35,000 more calculation. Now, if you record more depreciation expense, you have to eliminate it. So if you have to think 2 ways. If you record depreciation expense more, it will hit your net income, right? You record higher depreciation expense, it means that you have lower net income, right? And if you record lower depreciation expense, it means that you have higher net income. So according to this example, we have excess depreciation expense. And because of the excess depreciation expense, our net income is going to drop, right? So we have to adjust in both sides. Our first adjustment, we are going to decrease our depreciation expense, okay, to make the original amount. What is the original amount? $95,000. And I told you that, look at the journal. If you have any excess depreciation, you have to eliminate this, right? If you have any depreciation expense excess, you have to eliminate. If you have lower, you have to add. According to this example, we record more. But if your exam question, you record less, then our journal is opposite. Journal, we should have opposite journal. So according to this example, we have excess depreciation. Now we are going to minimize this. If you record depreciation expense credit, try to understand. If you record depreciation expense credit, what does it mean? It means that your depreciation expense decrease, right? And opposite, you have to record accumulated depreciation debit. So accumulated depreciation expense debit, sorry, not expense, accumulated depreciation equipment debit and depreciation expense credit, $15,000. Why $15,000? Because I told you that, read the question very carefully. It is from June 30, right? From June 30, so we should think about only 6 months. So although it is $30,000, but it is for full years. But the consolidated financial statement, they considered this from June 30, right? From June 30. Therefore, total $300,000 is not excess because it is for 1 year, but 6 months, it is only 15,000. For 6 months, it is only 15,000. So we record depreciation expense credit. It means that the excess amount is going to drop, right? Excess amount is going to drop, and we record accumulated depreciation debit. So this is the journal entry and the adjustment for 2021. This is the journal entry and adjustment for 2021. We close intercompany gain. We record the asset in its original shape, and as parent company record higher depreciation expense, it is their mistake because depreciation should be based on original cost. Now, when they prepare consolidated financial statement, they said that whenever, look at here, whenever subsidiary prepare their statement, it is their depreciation. When parents company prepare financial statement, it is their depreciation, right? But when consolidated came, it should be based on original cost. And consolidated financial statement found that 30,000 is higher. So they will decrease this 30,000, but they no need to decrease 30,000 whole amount because it is for 6 months. Therefore, they record depreciation expense credit. It means that it is decrease. It means that it is decrease. It is decrease. Now, when 2022 came, we have to copy this journal entry. Look at here. When 2020, this is 2021, right? When we go to 2022, we do the same journal entry. We do the same journal entry. What is the journal entry? We have to return back the asset to its original shape. And if you remember my first class about this topic, this is the gain we eliminate, right? This gain, this gain we eliminate. But we know that this gain already transferred to where? Already transferred to the retained earnings, right? So you have to eliminate from two parts, one from subsidiary account, right? And another from the consolidated, So from subsidiary account, we already eliminate the gain, right? Now look at here, I should copy this. Okay, I should copy and paste in the next year. Look at here, copy and paste. Look at this part. Look at this part and this part. So it means that it is number 2. This is number 2. That means we already return back the asset in its original shape, right? And previously we eliminate gain or loss, and we know this gain or loss goes to the retained earnings, right? So we eliminate retained earnings. And 2021 ending retained earnings is the 2022 beginning retained earnings. Clear? So we have to eliminate from two sides, from subsidiary account and from consolidated financial statement. And this is number one actually. This is number one. We eliminate intercompany gain. We eliminate intercompany gain. And as it is upstream sale, as it is upstream sales, so we have parent and we have NCI. Right? Parent company share 80%, parent company share 80%, and subsidiary share 20%, NCI share 20%. So this is the same journal entry. Year 1 and year 2, same journal entry. But the difference is year 1, we eliminate gain or loss from subsidiary account, and this gain or loss already transferred to the consolidated retained earnings, right? And we eliminate this gain or loss from the retained earnings. Yes. And here you can see that this year, again, this is the subsidiary companies record depreciation expense in their separate book, right? Parent company record depreciation expense separately, but when consolidated financial statement came, consolidated financial find that 30,000 is higher. Clear? Now this same journal, look at here, this one, same journal, they have to do every year. Every year they have to consolidate financial statement, do the same. This one and this one is same, but difference is the number, amount. Before we record only 15,000 because it was 6 months. Now 2022 cover full year, right? Cover full year. That's why it is $30,000. So this journal entry, we decrease our depreciation expense from consolidated financial statement. This journal entry is similar for 2022, but the full amount. Okay. Now 2022, you have to do some additional journal entry. Which one is the additional? This one. You remember that we record depreciation expense credit, right? Depreciation expense credit means your net income will increase, right? Your net income will increase. And we did it at the end of the year. So this changes. That means as we decrease depreciation expense, it is going to affect to our consolidated financial statement. So because of this decreased depreciation, we have net income higher. And this net income higher is going to allocate to the parents company and NCI. So this is a journal entry. This is a journal entry. So we copy the same. Look at here. We just copy it. We record accumulated depreciation debit, okay? And because of depreciation expense, look at here. Because of depreciation expense, we have higher net income. And this higher net income, just we are going to allocate this. So we copy this, look at here. We copy this, copy the journal for next year. We copy this and paste. We copy and paste. Before we record here depreciation expense, right? But this depreciation expense give us more net income. That's why, look at here, our net income, that means our retained earnings credit, non-controlling interest credit. So this $15,000, this $15,000 is the net income increase, and we allocate this to two groups, parent and non-controlling interest. So next year, 2022, what should be the journal? Can you guess? 2022, what should be the journal? 2023. If 2023, the same journal, look at here. We record depreciation expense credit, right? Credit means depreciation expense decrease and net income increase. So here $30,000. Okay. Here 30. Then this is 24. This is 6. You understand? That means the next year. So I'm not asking this in this question, but if you find what happened in the next year, so every year we'll have the same journal. Every year we have to deduct because it is up to how many years? Up to 4 years. every year we have to do this. Why? Because every year parent company will record, look at here, every year parent company will record 125,000 depreciation expense, right? But consolidated said that we have to follow on original cost. So according to the original cost, every year we find that $30,000 is higher. So every year we delete this $30,000. Every year we have to delete this $30,000. And because of this, we have higher net income, we have to allocate this. Okay, so this question is about upstream sales. If it is downstream sales, okay, year one do not have any problem. Why year one do not have any problem if it is downstream sale? Because we are not going to allocate any profit and loss, right, to the parents and non-controlling interest. So now we have another question. For the complete equity method, okay, sorry, we done partial equity and cost method. For complete equity method, I told you that here, if it is complete equity method, okay, everything similar, only we should include investment in subsidiary, okay, instead of retained earnings. So instead of retained earnings account, okay, instead of retained earnings account, everything is similar. We do not write retained earnings, we just only write investment in subsidiary. You remember this, right? If it is complete equity method, everything similar. Just one transaction, one account title is different. Which account title is different? Look at here. According to the cost method, we record beginning retained earnings, right? But complete method said that it is only change here. This is the only change. This is the only change. Just account title change. Okay? Just account title change. Because according to equity method, everything is adjusted, every gain or loss is going to adjust with investment. Okay, according to equity method, I mean complete equity method, every gain or loss is going to adjust with investment account. But if it is cost method or partial equity method, we just record here retained earnings. Okay. The same question, I repeat again, the same question, but it is downstream sales. Downstream sales means parent sell asset to subsidiary. Okay. Again, if it is downstream sale, everything is similar. Only we don't have NCI. Okay. Everything similar. Look at here. Everything similar. If it is downstream, everything similar. Year one. Okay. Everything similar. But we don't have NCI. We only have parent, because parent no need to share their profit with anyone. Okay. Parents will record 100% of their profit or loss. Do you understand? So that's why we don't have any NCI, but everything similar. Again, complete equity method, everything similar, just we use investment in subsidiary. So there is no difference between controlling interest and non-controlling interest with downstream intercompany sales. There is no difference if it is downstream. That means we don't have any NCI. Okay, this is all about this chapter. You can expect 2 questions from part A and one question from part A, one question from part B. Just I will have same thing, just change the number.